Welcome to video 2 of part 2 of the EA Tax Training free EA exam prep course for 2025. Tom here, back with you to discuss accounting methods and business income. This is the main video that is going to be heavy on accounting rather than just tax, although video 3 will also have a little accounting in it as well. You don't have to be an accountant to prepare business tax returns, but it does help to have at least some accounting or bookkeeping background, especially if you are dealing with larger or more complicated businesses. In this video, I'll give you just enough accounting knowledge so you can pass the EA exam. So watch it as many times as you need to and study the slides and the free resources. Specifically in this video, what we will study is we'll do an overview of accounting and financial statements. Then we'll talk about accounting methods. Then we'll talk about determining business income. And finally, inventory and cost of goods sold. Our free resources from irs.gov for this video, we've got publication 334 again. Then we've got publication 538 here in bold as well, accounting periods and methods. And then we've got this form 3115, application for change in accounting method and its instructions. And then there are a couple of other publications you may want to check out as well. But let's start with an overview of accounting and financial statements. This is the basic accounting equation. If you've ever taken an accounting or a bookkeeping course anywhere, you will have learned this at the very beginning of your course. This equation is assets equals liabilities plus owner's equity. It is said if you truly understand this equation, then you can solve any accounting problem. This equation is accounting. The easiest way to understand what this equation means is to think about this hypothetical scenario. Let's say you have a business, it's got some assets, and you decide to shut the business down. You are going to go out of business. You are going to liquidate it. So you sell all of your assets. At that point, you would then be sitting on a pile of cash. What would you do with that cash? Well, the first thing you would do is you would pay off any debts of the business. So those are the liabilities. And then anything that is left over belongs to the owners. So the rest of the cash would go to the owners. That is the owner's equity. So assets has to equal liabilities plus owner's equity because there's nothing else to do with the assets. The assets either go to satisfy the liabilities or they go back to the owners. So that is owner's equity. So every time we record a financial transaction for the business, we need to make sure that this equation balances. How do we do that? This is where we have double entry accounting or double entry bookkeeping. If you've taken a bookkeeping or an accounting course anywhere in the world, this is what you have learned. And you've probably heard of debits and credits. So what double entry bookkeeping says is that for every financial transaction, we have to do two offsetting entries of equal dollar amounts. In order to do those entries, we use something called debits and credits. And as long as those entries are of equal dollar amounts and you follow the rules of debits and credits, then this equation will always be in balance. I am not going to go deep into debits and credits in this video. However, I did make another video. It's on the EA Tax Training YouTube page. It's not part of this course. But if you're interested, it is called An Easy Way to Remember Debits and Credits. It's less than 30 minutes long. I've had a lot of great feedback. People say, finally, I understand debits and credits. Thank you. So if you want some more information about how debits and credits work and how this accounting equation works, I encourage you to go ahead and take 30 minutes out of your day and watch that video. Is it absolutely necessary? No, it is not necessary. You may have a question or two on the EA exam that has to do with debits and credits. They might say, should you debit this account and credit this account or something like that. Even if you miss those one or two questions, you can still easily pass the EA exam. So it is not necessary. As we go through the course, I may say, hey, here's one of those that you might want to remember, that you might want to pay attention to. But again, even if you don't, you can just guess on those questions and you will be fine. But if you are interested, then go ahead and watch that video and just study a little bit more so that you can understand a little bit better what you are looking at when you are looking at the finances of a business. When we are doing accounting, what we are doing is simply recording the revenue and the expenses and the assets and the liabilities and the equities for the business. And it doesn't matter what type of entity you choose, if you're a sole proprietorship or a corporation, a partnership, does not matter. You're going to be reporting essentially the same things. And especially when we talk about revenue and expenses, you're going to have basically the same types of revenue, the same types of expenses, regardless of which entity you have. You're just going to put it on a different form. So, for instance, you sell a product or a service, that of course creates revenue. You're going to incur costs in the course of offering those products and services for sale. So those are expenses. So to the extent your revenues exceed your expenses, you've got a profit. To the extent that your expenses exceed your revenue, then you have a loss. It really is that easy. The revenue and expenses for any period, which could be a month, a quarter, a tax year, really any period you want, are summarized on something called an income statement. Now, for tax purposes, we're usually going to be looking at an annual income statement that covers the entire year. This may also be called a profit and loss statement or a P&L. In the last few years, I've even heard it called a PNL, which is kind of new to me, but I guess it comes up because when you say P&L kind of fast, it sounds like PNL, even though you're actually saying P and L. But in any case, it's all the same thing. If you are dealing with a not-for-profit entity or with a governmental entity, they don't technically have a profit or a loss. So this statement might be called something like the statement of revenue and expenses. But no matter what it's called, it is all the same thing. It shows your revenue, shows your expenses, and it shows the difference. And of course, this is where the majority of the information for the tax return is going to come from, because we are interested in what is your income, your taxable income after you subtract your deductions. So the income statement will be the main statement that we are concerned with. This is a sample of an income statement, so let's have a closer look at it. At the top, we are going to start with our revenue, and you can see here at the top sales, and this might be called something different on different income statements. The categories I'm showing here are just samples. The ones that you see might look the same. They might use slightly different wording. There might be more categories. There might be fewer categories, but it's the same basic idea. You're going to start with your sales revenue. You're going to subtract your cost of goods sold, which we are going to talk about in detail in this video. That will leave you with your gross profit. Then you're going to have your other types of income or revenue accounts that you could have, and that's going to give you your total revenue. Then you're going to come down to your expenses. And again, these are just samples. You could have salaries and wages and benefits and rent and supplies, maintenance and repairs, etc. You add up all of your expenses, subtract them from your revenue. That leaves you with a net income. You may have noticed that we've got 2 years here, and this is typical. Usually when we are looking at financial statements, we like to be able to compare them to the prior period to have an idea if there's been big changes or what the trends might be. So here you can see we've got 2024 compared to 2023. So that is the income statement or the profit and loss statement. The next financial statement that you will often see is called a balance sheet. So this is where we record those assets, liabilities, and equity, like we talked about with the basic accounting equation. So the business will have assets, that's what it owns, and it will have liabilities, that is what it owes. The difference between the assets and the liabilities is the owner's equity in the business. Remember, if we sold all the assets, paid off the liabilities, what's left over belongs to the owners. That is owner's equity. So these accounts, the asset, liability, and equity accounts, need to be tracked and increases and decreases accounted for in order to have an accurate balance sheet. The end result of all that tracking will be shown on that balance sheet, which shows all of those amounts, assets, liabilities, and equity, on a particular day, such as the last day of the month or of the year. Again, when we are looking at it for tax purposes, usually we will be looking at the last day of the tax year. So here is a simple example of a balance sheet. So you can see on the left are the assets, on the right are the liabilities and equity. Remember, those have to be the same. Assets has to equal liabilities plus owner's equity. So we say those have to balance. We put this on a sheet of paper. Therefore, we call it a balance sheet. So that's really all there is to it. Now, the balance sheets you see might have a lot more categories of this, or it might even have fewer categories than this. But let's have a closer look at it so we can see exactly what it looks like. So on the asset side, you're going to start at the top with what we call current assets. Sometimes there'll actually be a subheading that says current assets, and then there'll be another one that says non-current assets or long-term assets or something like that. But you don't have to. In this one, we don't have that. But still, we're going to put our current assets towards the top. What does that mean? A current asset is an asset that is either already cash or nearly cash, or that we expect to turn into cash within the next year. So cash and investments, that's essentially already cash. So that's obviously a current asset. Accounts receivable, that's amounts that our customers owe us for products or services that we have already delivered. So we expect to collect that within the next year. So that's a current asset. Inventory is the products that we have on hand that we expect to sell. We expect to sell those in the next year. So that is a current asset. And then you can just have this catch-all other current assets. And again, there can be other current assets as well. But on this sample, this is the ones that we have. Then you get into your longer term assets, which is things like equipment and machinery, buildings, if you had those. So anything that you don't expect to dispose of within a year would go into the long term of the non-current assets. So here we show equipment of 100,000, and then we've got accumulated depreciation of 80,000. We'll talk all about depreciation in our next video. And that leaves us with a net amount. So we call this the net equipment. You could have other assets, of course, and then that totals up to your total assets. When we go over here and we look at liabilities and equity, we're going to start again with what are called current liabilities. Those are liabilities that you expect to pay off within the next year. So you've got accounts payable. That's amounts that your business owes to other businesses for products or services that you've already received. You expect to pay those within the next year. That is a current liability. Bank loans current portion. So you could have a bank loan, for example, that is due over 5 years. So let's say in this example, we've got $100,000 of bank loans. 20,000 of that is due within the next year. So we're going to call that a current liability. The other $80,000 is not due in the next year. It's due in years 2, 3, 4, and 5. So it goes down here into long-term liabilities. You could have other current liabilities as well. And then something you will see quite frequently on smaller businesses is loans from owners. So sometimes the owner, instead of putting equity into the business, they will loan money to the business. And if they do that, then that shows up on the business's balance sheet as a liability. And then you can have other liabilities. Finally, then at the bottom, we're going to show equity. And again, depending on the business, equity could be several lines long. In this one, we've got it all in one line here where we show the equity of $450,500. When you add all that up together, that's the same $652,000 that we saw on the asset side. These together, the income statement and the balance sheet, and sometimes others, are called the financial statements. So the income statement records revenue and expense activity over a period of time, for example, a calendar year. So it is likened to a motion picture because it is showing you the net result of all the activity from January 1st through December 31st. All the revenue that was received, all the expenses that you had are all captured on that income statement. The balance sheet, on the other hand, is likened to a snapshot, since it shows the amount of assets, liabilities, and equity on one particular day. So the balance sheet is just showing you, for instance, what those account balances are on December 31st. So you can remember that income statement like a motion picture, balance sheet like a snapshot. These financial statements are linked. So the net income from the income statement is going to flow to the owner's equity section on the balance sheet. And you will sometimes see other financial statements in addition to these two. So, for instance, one that's pretty common is called a statement of cash flows. When we looked at that income statement, that was not necessarily the same thing. And usually it's not going to be the same thing as cash in and cash out. Because, for instance, you could get a loan from the bank for $10,000. Now you've got $10,000 more cash than you had, but that's not income to the business. That's a liability that they have to pay back. Similarly, when they pay off those loans, those liabilities, the amount that they are paying off is not an expense to the business. It's simply a reduction in the liability. So those things affect cash, but they don't affect the income statement. There's lots of other things like that as well. So what a statement of cash flows does is it shows you all of the sources of your cash, and then it shows you all of the uses of your cash, and then it shows you, do you have more cash or less cash than you had at the beginning of the year. You can also have other statements, such as a statement of owner's equity or a statement of shareholders' equity. So if you ever look at the balance sheet of a big publicly traded corporation, they will almost certainly have this statement of shareholders' equity. They'll show you what shareholders' equity was at the beginning of the year, and then they'll show all of the changes, and then they'll show you shareholders' equity at the end of the year. And that reminds me, if you are interested in this, if you are interested in accounting, it can be instructive and interesting to actually look at some of these big businesses' financial statements. If they are publicly traded, they have to file those statements with the Securities and Exchange Commission. So they are public information. So you can go find them online. You can even call or write to the company, and they'll usually send you a hard copy of their annual report because it's for investors. They want people to invest in the company. So they put together this nice glossy annual report. That'll have like a letter from the CEO talking about how the company did last year and what the future looks like. It'll have all of the financial statements, and then it will also have what are called notes to the financial statements. So the financial statements of these big companies have to be audited by a CPA firm. And so when they are, the CPAs will look through and they'll say, these numbers need some explanation. So they will write notes to give more explanation about some of the numbers. So those are called notes to the financial statements. So it can be really interesting to do this. Think of a company or a business that you're familiar with, that you do business with on a regular basis. Get a copy of their financial statements and just look through those and see what it looks like. I think it will be instructive for you. Book versus tax differences. So these financial statements we've been talking about is what we're going to call books. So the books means the records in financial statements that the business keeps on a regular basis. In accounting, this is called financial accounting as opposed to, for example, tax accounting. And financial accounting follows something called generally accepted accounting principles, GAAP, pronounced GAAP. GAAP is the collective knowledge and experience of the accounting industry for hundreds of years. So over the years, there have become accepted ways to account for things. And there are actually bodies of accountants in the United States and even all over the world who think about how should things be accounted for. And as the economy changes, as technology advances, they say, you know what, we need to do things differently, or we need to do something different. For instance, there were never cryptocurrencies in the past. So how do you account for those? So they have to come up with some sort of guidelines for that. And so they will publish these things. So there are some things that we just do because that's the way it's always been done and it makes sense. There are other things that are actually published by these boards that say, hey, this is how you should do things. If you are in the United States and you are following generally accepted accounting principles, then this is how you should do it. There are worldwide organizations that say, okay, on a worldwide basis, here's what we're going to agree to. So even if it's international, these are the standards we're going to use. So all of this is generally accepted accounting principles. Tax is not based on generally accepted accounting principles. The tax rules were created by politicians. They're created by congressmen, they're signed by the president, and they've been done over years and years and years. So it's different politicians at different times, different presidents at different times, and all of this law is kind of built on itself over time until we have the Internal Revenue Code. So sometimes The politicians want to encourage individuals and businesses to do certain things, so they will allow certain deductions that might not be allowed under GAAP. Or sometimes there are deductions allowed under GAAP that the politicians are like, no, we don't want to encourage that type of behavior. Therefore, we are not going to allow a deduction for that. So, for example, where they might give you an extra deduction is if they want businesses to invest in more equipment because that can help spur the economy, they may allow you to deduct the full cost of the equipment that you buy all in 1 year, all in the year that you buy it. Well, that's not allowed under generally accepted accounting principles. You have to depreciate that asset over a number of years, but it can be allowed sometimes in the tax law. On the other hand, they may want to discourage behavior. So, for example, if a business wants to make a political contribution to a particular candidate because they think that candidate will be good for business, they can do that, and that can be a deduction under GAAP. But Congress says, no, we don't want to encourage these corporations to give money to politicians. We don't want to give them a tax break for that. So there's no tax deduction allowed for making those contributions. That's just a couple of examples. Now, having said that, I don't want to give the impression that there's lots and lots of differences. Most of the things are handled the same way for both book and tax. So if you look at the income statement and you see gross revenue and salaries and repairs and maintenance, all of these basic things are going to be handled the same way, but there are going to be a few things that are different. Those differences are called book to tax differences. And when you file your tax return, if you're large enough, not every business has to file a balance sheet, for example, with their income tax return. Only larger businesses have to do that. But if they have to file that balance sheet, it's on something called Schedule L. Then underneath that is something called Schedule M. And on Schedule M, the business actually has to show their book and tax differences. So you start with, here's what our book income was. Then you show each of the things that is different. And then you end up with, here's our taxable income. So you actually have to show the IRS what were these differences between book and tax. Now let's move on and talk about accounting methods. We talked a little bit about this in part 1, but we're going to go into more detail about it here in part 2. What is an accounting method? It is a set of rules used to determine when and how revenue and expenses are reported on your tax return. It includes not only your overall method of accounting, of doing that, but also how you account for any material item, and material just means significant. Whatever method you use, it must clearly reflect your revenue and expenses, and you must maintain records that will enable you to file a correct tax return. Here are the methods you can use. The two that we usually talk about, and we talked about in part 1, are the cash method and the accrual method. That is the primary distinction. You will want to know, does the business use the cash method or the accrual method for tax purposes? You can also use a hybrid method, which is part cash and part accrual. We'll talk about that. And then there can be special methods for certain items, such as long-term contracts or installment sales. One important thing to note, when we're talking about especially this cash versus accrual, it can be different for book purposes and tax purposes. So, for example, you can use accrual for book purposes and cash for tax purposes, or vice versa. So, you don't have to use the same method. This is going to be important for you when you are doing tax returns. You're going to need to know, okay, let's say you're getting the financial statements from the business, you're going to use those to help prepare the tax return. You need to know, are those financial statements, their books, kept on the cash method or on the accrual method? Then you need to know, how is the tax return done? Is it done on the cash method or the accrual method? And if it's different, then you're going to have to make some adjustments to those returns. So we'll talk a little bit more about that later. Let's talk first about the cash method. This is a recap from part 1. So in general, with the cash method, income is recognized when it is received and expenses are recognized when they are actually paid. But don't forget about constructive receipt. You recognize income when it is credited to your account or made available to you without restriction. So for example, Fred's Flower Shop receives a $500 check from a customer for a large order of flowers on December 31st, 2024. Fred's doesn't deposit the check until January 2nd, 2025. The $500 is income in 2024 because that's when they had it and they could have deposited it. So that's when we are going to consider it income. Even if you're using the cash method, there are going to be times when you cannot deduct all of your expenses. If those expenses are for periods that are far into the future. Instead, those expenses will have to be capitalized and deducted in the year to which they apply. So when we say capitalized, what we mean is we have to set it up as an asset on the balance sheet. We'll do an example here in a minute. The 12-month rule says you can deduct an expense currently if the payment is for a benefit that does not extend beyond the earlier of 12 months after the benefit begins or the end of the tax year after the year in which the payment is made. So basically, you want to think about, is this payment that we're making for something that we're not going to receive for greater than 12 months from now? That's what the 12-month rule is saying. You can only deduct currently the part that is going to be used in the next 12 months. So let's do an example. On December 31st, 2024, Fred's Flower Shop pays $9,000 in full for a 3-year insurance policy. Fred's can deduct $3,000 in 2024 and another $3,000 in 2025 and another $3,000 in 2026. So what you would do here is, from an accounting standpoint, is you say, okay, we paid out $9,000. Normally we'd say, well, it's a cash business. They can deduct $9,000. But the 12-month rule says, no, you can't do that. You can only deduct $3,000. So what we do instead is we say, okay, we have a deduction and expense for $3,000. The other $6,000 becomes an asset on the balance sheet called prepaid insurance. Why is that an asset? It's an asset because technically the insurance company owes you that money. Let's say the insurance company decided to get out of the flower shop insurance business after 1 year. So you got your 1 year of insurance, and then the insurance company made a corporate-wide decision, you know what, we're not going to insure flower shops anymore. Well, they would have to give that $6,000 back to Fred's Flower Shop. Or let's say, maybe this is more realistic, let's say the insurance company said, you know what, Fred's Flower Shop is in Florida where there's lots of hurricanes, and we don't want to be anywhere near the hurricanes anymore. So we are no longer going to insure anybody in Florida. So again, they would have to pay Fred's their $6,000 back for the insurance they did not provide. So that goes on the balance sheet as an asset. And then the more normal case, rather than getting your money back, is what's going to happen is next year it's going to come along and Fred's is still going to be insured by that company. So they will record another $3,000 of expense and they will reduce that prepaid insurance asset by $3,000. So now that asset will only be $3,000 instead of $6,000. And then when 2026 comes along, they will record the last $3,000 and that prepaid insurance amount will go to zero. There are certain businesses that are not allowed to use the cash method for tax purposes. It is a limited number that are not allowed to use it, but you do need to know this for the exam. C corporations with average annual gross receipts over the last 3 years in excess of $30 million cannot use the cash method. So, for example, if it's a C corporation, in their last 3 years, they had $33 million, $30 million, and $28 million of gross receipts. That's a total of $91 million. Divide by 3, that is more than $30 million per year on average. They cannot use the cash method unless they are a personal services corporation. Remember, a personal services corporation is a type of C corporation, and they can still use the cash method even if they do have this large amount of gross receipts. The other types of businesses that cannot use the cash method is any partnership that has one of these large C corporations as a partner. Since the income from the partnership is going to flow through to the C corporation, since the C corporation can't use the cash method, The partnership cannot use the cash method either. And then the final one is any tax shelter. So it could be a partnership, could be a corporation. If they qualify as being a tax shelter under the law, then they cannot use the cash method. You do not need to understand what qualifies as a tax shelter under the law for the EA exam. Just know that it is on this list of exceptions. You also want to remember this $30 million number because it is used here and it is used in a few other places as well. And it does change each year with inflation. But for 2024, it is $30 million. So remember, cash method, no C corporation with those annual receipts over $30 million, no partnership that has one of those C corporations as a partner, and no tax shelter. None of them can use the cash method. Now let's talk about the accrual method. With the accrual method, revenue is recognized when it is earned, regardless of when the cash is actually received. Similarly, expenses are recognized when they are incurred, regardless of when the bill is actually paid. The accrual method more accurately reflects the business's true financial picture than the cash method does, and that is why it is the method required by generally accepted accounting principles. So if you are following GAAP accounting on your books, you cannot use the cash method for book purposes. You have to use the accrual method. But remember, for tax purposes, unless you are one of those businesses on that previous slide, you can use either the cash or the accrual method for tax purposes. So just because you have to use it for your books does not mean you have to use it for your tax return. If you have that situation where you have got a business that is using accrual for book purposes, but for the tax return, they are cash, they may give you their financial statements that are done on the accrual basis. You are then going to have to do something called an accrual to cash conversion. If you take an accounting course, you will learn how to do this. This is one of those cases where it really helps to be an accountant or a bookkeeper because you need to understand accounting in order to understand how to do this accrual to cash conversion. So you would do that, and that would be another book to tax difference that you would have. For the accrual method, when we're looking at revenue, revenue is going to be recognized when any one of the following occurs. First of all, if payment is received. So if you're providing a product or a service, the customer pays you right then and there for it, you've received payment. Of course, you are then going to recognize that as income. Also, once the business has earned the revenue, so let's say you provide a service and the customer does not pay you then and there. So instead, you send them an invoice or you give them an invoice and they pay you later. Well, you have now earned that revenue because you have provided that service. They owe that money to you. Therefore, you will recognize it as income on the accrual method. Similarly, when the revenue is due to the business. So let's say you give somebody a product and you say, hey, take it home, try it for 3 days. And if you don't like it, bring it back. If you like it, then keep it and we will send you a bill. Once the 3 days is over, they owe you that money. So you would go ahead and recognize that income. And then the last one is when title to property sold has passed to the purchaser. So if title has passed, then we will go ahead and recognize the revenue at that time. This is something that you may be tested on the EA exam. So we're going to go into a little bit more detail about this whole concept of when does title to property pass from the seller to the purchaser. There are 3 basic ways that the title can pass. The first is called FOB destination. The second is called FOB shipping point. And the third is called COD or cash on delivery. So FOB destination, FOB stands for free on board. So what this says is that title passes to the buyer when the property reaches the buyer's location. The seller bears the risk of loss in transit. So you've got somebody, let's say, that is selling a large machine, and this machine has to be shipped on a truck. It could be on an airplane, could be on a ship, but let's say it's on a truck. FOB destination says The seller is going to put that on a truck. It's going to drive to the buyer's location. And as soon as it reaches the buyer's location, title has passed. If that truck crashes and catches fire en route to the buyer's location, it's the seller's problem. They're going to have to deal with it, not the buyer. FOB shipping point is the opposite. This is sometimes also called FOB origin. So here, the title passes to the buyer when the property reaches the point of shipment. The buyer bears the risk of loss in transit. So again, same machine, putting it on the truck. Soon as it's on the truck, title passes to the buyer. If the truck crashes and burns, that is the buyer's problem. They are going to have to deal with it. Of course, that's also telling you that as soon as it's on the truck, title has passed, which means the seller can recognize the revenue. If it was FOB destination, the seller does not recognize the revenue until the truck actually reaches the buyer's location. And then finally is cash on delivery, or COD. And what this says is just what it sounds like. The seller is going to put it on a truck, going to deliver it to the buyer, but that driver is not going to release it to the buyer until payment has been made. So classically, what they would do is the buyer would actually hand the driver a check and say, okay, here is your money. These days, it might be done by a wire transfer or some other electronic type of payment, but it is the same idea. Why would sellers do this? Oftentimes, this is done when the buyer either doesn't have very good credit or their financial statements are not very strong and it's a very expensive piece of equipment, and the seller is concerned that they're not going to get payment for their product. So what they're saying is, okay, we'll sell it to you, we'll deliver it to you, but we're not letting go of it until you actually pay us for it. So in that case, of course, the seller is going to bear the risk of loss in transit, because if that truck crashes and burns, title has not passed yet. And so therefore, it would be the seller's problem. And so with COD, the title will transfer when two things have happened. The product has been delivered and the buyer has paid for that product. On the expense side, so we've been talking about the revenue side. When do we recognize revenue? But what about the expense side? With the accrual method, expenses are recognized when the expense is incurred or the product or service is received. A bill for a service might span accounting periods, in which case part is included in one period and part in another. So, for example, ABC Company receives a cell phone bill for all of its employees' phones on January 16th of 2025. They pay the bill on February 1st of 2025. The bill is for the period December 16th, 2024 to January 15th, 2025. Half the expense is recorded in December and the other half in January. So note here, the bill was not paid until February of 2025, but none of the expense is recognized in February. Half of it is going to be recognized in December because it's for the period December 16th to December 31st. The other half is going to be recognized in the new year, January, because it's for the period January 1st to January 15th. Otherwise, if it doesn't span accounting periods, you're just going to recognize the expense whenever it is incurred. So if it's incurred in December, but you don't pay the bill until January or February of the following year, you're still going to count it as an expense in December. A hybrid method. A hybrid method is a combination of both cash and accrual. So a common example is inventory. A normally cash method business may account for inventory on an accrual basis, meaning both income and expenses related to inventory are accounted for using the accrual method. Other income and expenses would be accounted for using the cash method. There are a couple of rules to keep in mind here, and you will want to remember these for the exam. If you use the cash method for revenue, you must also use the cash method for expenses. So in other words, if you're going to wait to recognize the income until you actually receive the cash, you also have to wait to recognize the expenses until you actually pay for them with cash. That's what this is saying. The other rule is if you use the accrual method for expenses, then you must also use the accrual method for revenue. So in other words, if you are going to record your expenses now, as soon as the expense is incurred, then you also have to recognize the revenue now as soon as the revenue is earned. So they want to make sure that those two things match. So you will want to remember those two. Remember both of them. If you use cash for revenue, you have to use cash for expenses. If you use accrual for expenses, you have to use accrual for revenue. So what this is saying is that it would be okay if you wanted to use the accrual method for revenue and the cash method for expenses, they would allow that. I don't know of anybody who actually does that, but technically that would be allowed. Other accounting methods, as we said, accounting methods can apply not only to your overall method of accounting, such as cash or accrual, but also to specific items. So, for example, how you account for inventory or valuation of inventory, how you do your depreciation, which we'll talk about in our next video, how long-term contracts are handled in the construction industry, how installment sales are handled, etc. There can be other specific items that you can use a specific type of method of accounting for, and that is fine, again, as long as whatever method you use clearly reflects the revenue and expenses of the business, you are allowed to use it. Changing accounting methods. When you first file your tax return for your business, you can choose any accounting method or methods that you want to, again, as long as they accurately reflect income. So let's think of this as cash and accrual, but it can be for any type of items that you have a specific accounting method for. But cash or accrual, you're going to have to pick one or the other when you file your first business income tax return. And again, unless you're one of those businesses that's not allowed to use the cash method, you can choose either that you want. Once you do choose a method, though, then you're supposed to stick with it. However, you can request with the IRS to change your accounting method down the road if you want to, and the IRS may or may not allow you to do that. So some of the times you might want to change your accounting method is you want to switch from cash to accrual or vice versa, or you want to change your inventory method, which we're going to be talking about inventory methods here in a little bit, or you want to change a depreciation method. So all of those would be examples of when you might want to request a change in accounting method. Now, you do not need to request permission to simply correct an error, such as correcting the useful life of an asset for depreciation. So if you just made a mistake last year, you're doing your depreciation, you picked the wrong useful life for a particular asset, then you can just go ahead and correct that. That's not something that you have to request a change in accounting method for. If you are going to request a change in accounting method, you will do so by filing this form. It's Form 3115, Application for Change in Accounting Method. And there are two types of changes in accounting method. There are automatic changes and there are non-automatic changes. Most of the changes are automatic. So if you're going from cash to accrual or accrual to cash, for example, that's an automatic change. So most of them are. The instructions to the 3115 will tell you which ones are automatic and which ones are not automatic. With an automatic change, you file the Form 3115, but you are not going to hear back from the IRS unless they want to have a closer look at it. So most of the time, you just file your 3115, the IRS is fine with it, and you don't have to do anything else. However, you don't just file the 3115 once. If you got an automatic change, you're actually going to file it twice. First, you are going to attach it to the tax return for the year that you want the change to be in effect. So if you want it to be in effect for 2024, you are going to attach the 3115 to the 2024 tax return. In addition to that, you are going to send a duplicate to the IRS National Office. And again, the instructions to the form tell you how to do that. So with an automatic change, you're not going to hear back from the IRS unless they want to review it. You can just assume that you're good to go, and you can attach the 3115 to your tax return, send a separate copy to the IRS National Office, and as long as you never hear back, then you just change your accounting method and everything is good. If it is a non-automatic change, then you cannot just assume that it is good. In this case, you need to get permission from the IRS in advance before filing a tax return that adopts that change. So what you will do in this case is you use the same form, the 3115, you send it to the IRS national office. Obviously, it would be good to send it pretty far in advance so they have time to look at it and get back to you with whether or not it is approved. Either way, whether you've got an automatic change or a non-automatic change, you could have something called a Section 481A adjustment. When you adopt a new method of accounting, it is likely to cause a difference in your taxable income for that year. So it's different than it would have been under the other method of accounting. So if you make that change and it results in additional tax due, then you can spread out paying that tax over 4 years. You don't have to pay it all this year. On the other hand, if that change results in you getting a refund, then the government will go ahead and issue your refund in this year. So this is actually a pretty good deal. If you owe money, you can spread it out over 4 years, but if the IRS owes you money, you get it all now. But anytime you're changing, you do need to compute any difference in your taxable income to see what, if any, Section 481A adjustment that you have. Now let's talk about business income. There are different types of business income or revenue. There is, of course, sales of products and services. There can also be sales of business property. So that's, for instance, a van that you have that you are selling. That would be a type of income. Then you can just have this catch-all category of other income that we'll talk about. And C Corps also include in income on page 1 of their tax return these investment type of income or portfolio income. So it's rents and royalties, interest, dividends, and capital gains. As we'll see, the other entities, they still report these on a different part of the tax return, but they don't report it on page 1 of the return. So what do we mean, page 1 of the return? Well, this is the top part of the Form 1120. So the section here is called income. So you can see it starts with your gross receipts or sales. That's your sales of your products and services, less returns and allowances, leaves you your net sales. Then you've got cost of goods sold that you're going to subtract. That leaves you with your gross profit. And then you can see, again, this is a C Corp. So you've got dividends, interest, rents, royalties, capital gains. Net gain or loss from Form 4797. That's selling those business assets, such as that old van. That's where that would go. And then you've got other income that leads you to total income. Contrast that with an S corporation return. Again, this top section is income. Still start with gross receipts and less returns and allowances. You still subtract cost of goods sold, leaves you with gross profit. But here it jumps straight to that 4797. That's your sales of business property. You've got none of those portfolio or investment types of income. Then you've got your other income, leaving you with your total income. And a partnership return is nearly the same as the S Corp. The one thing that they do have that's a little different is if you are operating a farm, then you are going to attach Schedule F, just like you would if you were doing a 1040. We'll talk more about farming income later in this course. But the rest are all the same. Ordinary income, net gain or loss from 4797, other income, etc. But you don't see any of those investment type of income amounts. And then finally, Schedule C. So this is what you attach to your Form 1040. Again, gross receipts, less returns and allowances, less cost of goods sold, leaves you with your gross profit. Then you have your other income. Notice the 4797 is not on here. And that's because if you are selling assets that you use in your business, you would just put that on your normal Schedule D of your 1040. It wouldn't be a separate category on the Schedule C. So when we talk about the sales of products and services, as we saw in those tax returns, you start with your gross receipts or sales. Then you are going to subtract your returns and allowances. So returns, I think, is self-explanatory. Allowances might be things like rebates that you give after the sale. That equals your net sales. Then you are going to subtract this cost of goods sold. So if you're selling a product, for instance, it costs you a certain amount of money to buy that product. And so that would be considered the cost of goods sold, which leaves you with your gross profit. We're going to go into more detail about cost of goods sold here in a little bit. For sales of business property, these are reported on Form 4797. So this is to report sales of property that are used in your business as opposed to sales of inventory to your customers. So if you're selling buildings or land, vehicles, furniture, computers, etc. So for instance, let's say you operate a computer store, you sell computers to the public. Well, you probably also have computers that you use in your business that are not for sale to customers. Well, it might be that someday in the future you actually do sell one of those computers. But that is not a computer that you purchased in order to resell, so it would not be included in inventory. Instead, you would report the sale of that particular computer on this Form 4797. We'll talk more all about that in video 3. Other income. So this is, as I said, a catch-all for any income that doesn't fit into any of the other categories. So some examples would be debt forgiveness income, state and local tax refunds, lawsuit awards, taxable insurance proceeds, refunds for previously deducted products or services. So let's specifically look at debt forgiveness income because they like to test this on the EA exam. If a business debt is forgiven, it is considered debt forgiveness income, and generally it is going to be taxable. However, a cash basis taxpayer does not have to recognize income if the debt forgiveness is for something that would have been deductible. So, for example, XYZ LLC is a cash basis business and has a mechanic fix its delivery truck. XYZ runs into financial difficulties and the mechanic forgives the debt. Since the repairs would have been tax deductible, XYZ does not have to include the debt forgiveness in income. So why is this rule? What is the purpose of it? Well, it's putting a cash basis taxpayer on the same footing as an accrual basis taxpayer. Think about if you were an accrual basis taxpayer. Let's say it cost you $1,000 to get your truck fixed. What you would do then is, as soon as they fixed that truck, you would have, if you're on the accrual basis, a $1,000 repairs and maintenance expense. So you would deduct $1,000 for that. If the mechanic then forgave that debt, you ran into financial difficulties and the mechanic said, forget about it. You've been a good customer over the years. I'm sure you'll get back on your feet. Don't worry about the $1,000. If you were accrual basis, you would then have to include that $1,000 in your income. So you would have a $1,000 deduction for getting the truck fixed, and then you would have $1,000 of income for the debt forgiveness. So the net result would be zero. When you net those two together, it would have zero income tax effect. So this is just making it the same for cash basis taxpayers. Here, you're not going to deduct it as soon as the truck is fixed because you haven't paid for it yet. So when they forgive that debt, you don't have to include it in income, so you're still at zero. Either way, you are at zero. You took no deduction, you had no income, you are zero. So that is the purpose of that rule. But remember, the general rule is if a business debt is forgiven, it is considered debt forgiveness income and generally is taxable. This is just the exception to that rule. Portfolio income, as we saw, C Corps report this right there on page 1 in the income section. S Corps and partnerships do not. They will report it. They will put it on something called Schedule K, and then they will report out to their partners or shareholders on Schedule K1s. So if the business, let's say it's a partnership, if they have a capital gain, they will show the entire capital gain for the partnership on Schedule K, and then each partner will get their portion on a Schedule K1, and then those partners will report it on their separate tax returns. That's the way that works. For a sole proprietorship, they are simply going to report those amounts on their 1040. So they're just an individual taxpayer. If they have interest or dividends or capital gains, they just report those like any other interest or dividends or capital gains that they might have, as we talked about in part 1. Some things are not considered income. So first of all, loans received, as we said before. You receive a loan, yes, you've got more cash than you had before, but that's not income because you have to pay that money back. That's a liability. Issuance of stock or other investments in the business. So if the owner invests money into the business, that's not income to the business. That money belongs to the owner. So it's not considered income. Taxes that are collected and then turned over to the government, such as payroll tax or sales tax, are not considered income. So remember, we talked about you collect Social Security, Medicare, and you have to turn those over to the government. Well, when you receive those from your employees, when you withhold that amount, it's not considered income. And then when you turn the money over to the government, it's not considered an expense. When you receive it, it's not actually yours. It belongs to the government. You're just collecting it on their behalf. So it is a liability until you turn it over to the government, in which case the liability goes away. And then finally, like kind exchanges of property. If you'll remember, we talked about these in part one. If you have one of those within a business, it is not considered income. Our next topic is inventory and cost of goods sold. And this relates to income. That's why we're talking about it. It also relates to accounting methods because you have to choose an accounting method for how you handle your inventory. Cost of goods sold, even though technically it is a deduction, as you'll remember, it shows up in the income section of the tax return. Inventory is what we sell in order to generate revenue, which gives us income for the business. And as I said, we will have to choose what method we are using to handle our inventory. This does get tested on the EA exam, so we are going to spend some time to make sure that you understand this. Accounting for inventory. A business that sells or manufactures products must keep track of its inventory in order to accurately calculate its income. Not only should they track inventory in their accounting records, but they should also perform a physical inventory count at regular intervals, at least annually. Many businesses will count their inventory much more frequently. They might do it quarterly or monthly. Some of them do it daily or even by the shift. So, for instance, if you have a convenience store, the cigarettes are high theft targets. So they may actually make the clerks do an inventory of the cigarettes at the beginning of every shift. After you do a count of the physical inventory, then what you're going to do is a reconciliation. You're going to see what do we show in our accounting records that we think we have on hand versus what did we actually find when we went out and counted. And what this can do is help you to identify if there's theft going on, if there's any waste, like if some of the products, yes, we have them, but the package is open or the product is broken or something. So it's not something we can really sell to our customers. Or sometimes things might be obsolete. So you've had it in inventory for 5 years, nobody's buying it. It's outdated now. There's newer models that have come along, so it's obsolete. So we might as well get it out of our inventory. So that's why we want to do this count and we want to do this reconciliation process. So what do we actually include in inventory? So first of all, products that have been purchased for resale, obviously. Secondly, if you're a manufacturer, any raw materials that you've obtained, work in process, and finished products. So work in process just means you've started it. So it's not just raw materials anymore, but the product's not finished. So it's somewhere in between raw materials and finished product. That's called work in process. We include that. And then if you got any finished products that haven't been sold yet, those would be included as well. Also, any supplies that become part of the product, such as packaging, labels, etc. Any products purchased if title has passed, even if not physically on hand. So remember, we talked about the FOB shipping point. If you have something that's FOB shipping point, even if you haven't received it yet, title is passed, you include it in your inventory. Products that are out on consignment. So maybe you've got products that are being displayed in somebody else's store, or they're in a salesperson's van or truck, and they're going around trying to sell it. Still belongs to you. If it doesn't sell, it's coming back to you. So that is included in your inventory. And also products that are on display somewhere other than the business's location. So maybe for advertising purposes, you've got one of your products on display somewhere at the local mall or something like that. Still belongs to you, still included in your inventory. So what is not included in inventory? Well, first of all, products that are not for sale. So remember that computer that you use in your computer store business, that computer that you are using is not for sale, so it's not included in your inventory. Same way with any other type of equipment or vehicles that you may have. Products that you're selling on consignment for others. So maybe it's in your store, it's in your truck, but it doesn't actually belong to you. And once it sells, you're going to split the sale with the owner. But if it never sells, it's going back to whoever owns it. So that is not included in your inventory. Products that are already sold, but not yet delivered to the buyer. So maybe you sold it, sitting still in your warehouse, but just hasn't been delivered yet, not included in your inventory. And then any products that you purchased, but the title has not yet passed. So again, could be FOB destination. It's on its way. It's on the truck. Hasn't reached you yet. Not included in your inventory. Uniform capitalization, or UNICAP. Uniform capitalization requires capitalizing rather than expensing direct and indirect costs associated with manufacturing or producing tangible personal property or acquiring property for resale. It only applies to businesses with average gross receipts over the last 3 years of more than $30 million. And you're going to capitalize items such as labor, warehousing, marketing, maintenance, etc. This changes those items from being immediately deductible to being part of inventory on the balance sheet. So remember, we said capitalizing an item means putting it on the balance sheet rather than deducting it currently. So that's what UNICAP does. So a couple of things to note here. First of all, this only applies to large businesses. So they have to have more than that $30 million of average gross receipts over the last 3 years. Note here, it is not only C corporations. When we were talking about who could not use the cash method, it was only C corporations with $30 million or more of average gross receipts. Here it is any business with more than $30 million of the average gross receipts. You have to use UNICAP. So what are we saying here? What is UNICAP for? Let's think about a manufacturer of some large piece of equipment. It might take days, weeks, or longer to manufacture that equipment. And then once they're finished, it may not sell right away. This might be a very large piece of equipment, and they don't sell thousands of them per day. They might sell hundreds per year, for instance. So they might produce it now, sits in their warehouse for several months before it finally sells. So think about that examples. You've got people working in the factory and you're paying them salaries and you're paying them benefits. Normally, without UNICAP, when you pay those salaries or when you incur those salaries, you're going to go ahead and deduct them right now as an expense. What UNICAP is saying is, no, you can't do that. You're going to have to put the cost, for example, of those salaries of those people working in the factory, rather than counting that as an expense, you're going to have to add that to the value of the inventory. So you don't get a current expense for those salaries and wages. Now, does that mean you're never going to get to deduct them? No, it doesn't. Once you sell that item, that will then be part of cost of goods sold, and then you will deduct it at that time. What the IRS doesn't want these large companies doing is being able to deduct currently the expenses of manufacturing a product, even though they're not going to actually sell and recognize the income from that product for a long time from now. It could be several months or longer until they recognize the income. So they're saying you can deduct all of these expenses at the same time you recognize the income. And the way you do that is by making those expenses part of the value of the inventory. Then when the inventory sells, you recognize the income, you recognize cost of goods sold, and you get to take the deduction. That's what UNICAP is all about. You do not need to understand how to calculate UNICAP or anything else like that. Just understand the general principle. Remember, it only applies to these businesses with more than $30 million in average gross receipts over the last 3 years. And then you probably also want to remember just the general types of expenses that are capitalized, that are listed here: labor, warehousing, marketing, maintenance, etc. Small business exception. This is not an exception to UNICAP because UNICAP's already only for large businesses. This is a small business exception for how inventory is tracked and accounted for. A business that is not required to use the accrual method is not required to keep an inventory. The business must still use a method of accounting for their inventory, however, that clearly reflects income. They can use whatever method they want. For instance, they can use the method that is used for financial statements or for their books and records, as long as it clearly reflects income. Or they can treat inventory as non incidental materials and supplies, so the inventory costs can be deducted in the year the products are sold. So, what is this saying? It's saying that you don't have to have a formal inventory system and use a formal inventory method that we are about to talk about. We're about to talk about some different inventory methods. They're saying if you are not required to use the accrual method, remember, the only ones required to use the accrual method are those very large businesses, tax shelters, etc. Anybody else does not have to follow all of these rules that we're going to talk about of the various types of inventory systems. That said, you still got to keep track of your inventory because you still have to use a method that clearly reflects income. You just don't necessarily have to use one of the kind of accepted methods that we are going to talk about. And if you've got a small enough business that it's easy to keep track of, you're like, okay, I know I bought these inventory items this year. I know I sold all these items this year. Then you can just go ahead and deduct all of the inventory costs this year. So whatever you do, as long as it clearly reflects income, you are okay. Now, having said all of that, if you've got inventory that is a significant part of your business, from a business standpoint, forget about what the tax law requires, but just from a business standpoint, you are going to want a method to keep track of your inventory. If you don't, you could run into lots of problems. You could lose money due to theft, due to obsolescence, due to all of those things. So you still want that from a business standpoint, but the IRS is just saying it's not absolutely required for income tax purposes. When we're talking about inventory, we need to understand cost of goods sold because they are intimately related. How the business values their inventory on hand affects the cost of goods sold, and therefore it affects taxable income. Cost of goods sold is an expense, but as you'll recall, it is shown in the income section of the income statement and of the tax return. This is the formula for cost of goods sold. It is an accounting thing, but you will want to remember it for the EA exam. Here's how you calculate it. You take your beginning inventory, the value of your beginning inventory, you add in purchases or production costs if you're a manufacturer, you subtract your ending inventory, that gives you your cost of goods sold. So remember, beginning inventory plus purchases minus ending inventory equals cost of goods sold. Because of this equation and the way it works, the lower the value of your inventory at the end of the year, the higher the deduction for cost of goods sold, and thus the lower the taxable income. So we're subtracting ending inventory. So if this number is smaller, it is going to result in a larger cost of goods sold, which results in a smaller taxable income. So let's look at an example. So here we've got everything is the same except for the ending inventory. Beginning inventory is 30,000, purchases are 100,000. Ending inventory is either 40,000 or $25,000. You can see cost of goods sold in example 1 is 90,000 and in example 2 is $105,000. So you would have $15,000 less taxable income under example 2 than under example 1. So that is why taxpayers would like for ending inventory to be low. So that leads us into discussing how do you value that ending inventory. As you can see, it's an important component of cost of goods sold and therefore taxable income. So the most common method we use for valuing inventory is called the cost method. Here, you're going to record the cost of buying or producing an item. That is going to be the value of that inventory. So if you sell cars and you bought a car for $20,000 and you haven't sold that car yet, then when you are doing your inventory, you're going to say, I've got $20,000 of inventory for that car. If you've got 100 cars, then you're going to just say, how much does each car cost me? And you are going to say, that is the value of my ending inventory. Now, depending on the business, it's not always that easy and that straightforward. So that's what we're going to talk about, the different methods that you can use to come up with what the cost is. So these are the most common methods of determining your cost. There's something called the specific identification method. What I just said about the cars, you've got this car, you paid this much for it. That's called the specific identification method. You've also got these other methods, FIFO, which stands for first in, first out, LIFO, which stands for last in, first out, and then something called the average cost method. So we are going to look at each of these. Specific identification method. Here, each item is identified individually and it is tracked. This is a good system if you've got a limited number of high dollar items that can be readily distinguished one from the other. So, for example, you've got computers that all have serial numbers. You've got vehicles that all have vehicle identification numbers, or you've got specially manufactured items that are unique. So, you know that you normally manufacture a certain type of item, but you've got this one customer that wanted this one special thing. And so you made this unique for them. So you can track that pretty easily. With the specific identification method, you are not making any assumptions. You're not assuming how much you paid for that car. You know that that car with that vehicle identification number that you paid this much money for, $20,000, that's how much you paid. So you can specifically identify that car, specifically identify how much you paid for it. So this is probably the best method. It's the most accurate method that you could have. Unfortunately, it's not practical for many businesses. So if you think about, for instance, like a hardware store, and they sell hammers and nails and screwdrivers, and they're buying them all the time, they're selling them all the time. How do you know when you sold this hammer versus that hammer? So it's not easy to specifically identify it. In essence, it's impossible to do that. Or think about buying a bunch of nails, for instance. How do you know which nail you paid what for? So we can't use this. But for those items that you can use it, it is a great method to use. Our next method is FIFO, first in, first out. Here, the oldest items in inventory are assumed to be the first ones that are sold. What's left in inventory are the most recently purchased or produced items, and this most accurately reflects reality in many businesses. I think it's also the most intuitive. So if you're selling hammers, it would be the most intuitive to think, okay, I've got all these hammers. I bought some of them 3 months ago, some of them 2 months ago, some of them 1 month ago, or whatever. I'm just going to assume that the hammer I sell today is one of those that I bought 3 months ago. So that's it. First ones I purchased are the first ones I sold. First in, first out. The opposite of that is LIFO, last in, first out. So here, the newest items in inventory are assumed to be the first ones sold. What's left in inventory are the oldest purchased or produced items. In times of inflation, this results in a lower ending inventory and higher cost of goods sold and lower taxable income. So this is what we were saying. Taxpayers in general would like a lower ending inventory value, so they might want to use LIFO. Of course, the IRS knows this, and so there are complex rules around LIFO and when you can use it and how you use it. You do not have to know those rules for the EA exam. You just want to understand that LIFO does, in fact, result in lower taxable income in times of inflation. And so that's why it is going to be scrutinized more closely by the IRS. So if you think about this with our hammers, this would just be saying the opposite of what we said before. If you bought some 3 months ago, 2 months ago, and 1 month ago, if you sold a hammer today, you would assume that the one you sold was the one you just bought a month ago. That would be the LIFO method. And then our final method under the cost method is average cost. Here, you calculate an average cost per unit purchased, no matter when it was purchased, and then you apply that average cost to the number of units in ending inventory. This can work well when you have a large number of homogeneous items that are difficult to distinguish one from the other, such as the hammers or the nails, etc. So now we are going to do an example. We're going to use the same fact pattern, and we're going to look at the result if we use FIFO, LIFO, or average cost. So we've got Sal's Sporting Goods. They've got 700 basketballs on hand as of January 1st with a cost of $10 each. So that's their opening inventory. And then I'm not going to read all this to you, but you can see here throughout the year, they are going to purchase more and more basketballs at various times. Each time they purchase them, this is a inflationary environment. So each time the cost is going to be a little bit more than it was last time. During the year, so all through the year, January 1st to December 31st, they sell 2,100 basketballs. So the question is, what is the value of their ending basketball inventory on December 31st? Now, of course, in the real world, Sal's Sporting Goods doesn't sell only basketballs. They sell lots and lots of different items. So they may not look at it specifically on an item by item basis. But in order for us to understand how all of this works, that's what we are going to do. We're just going to look at the basketball inventory. So first, under FIFO, all of this top part is exactly the same in all three of these that we are going to be looking at. So you've got your beginning inventory. Remember, they had 700 basketballs on hand that they had paid $10 for. So their opening inventory is $7,000. Then they made these purchases throughout the year, 500, 600, 700, 400. And so their total units that they purchased were 2,900, and they paid $30,210 in total for those. They sold 2,100 units, which leaves them with 800 basketballs. So here's the question. They sold 2,100. Which 2,100 are we going to assume that they sold? Well, this is first in, first out. So we're going to go back to the beginning inventory. We're going to say, well, they sold these 700. They sold these 500, so that's 1,200. Then they sold these 600, that's 1,800. Then they sold 300 of these, so that's 2,100. So they've still got 400 basketballs from the July 23rd batch that they paid $10.60 for. And they've got all 400 basketballs from the October 23rd batch that they paid $11 for. And so that's what we see down here. 400 times 11, 400 times $10.60. So their total ending inventory is $8,640. Now let's look at the same thing under LIFO. So all of this, again, is the same. So they sold 2,100 basketballs. Which 2,100 did they sell? Well, it's the last in, first out. So that means they're going to assume that they sold these 400, these 700, that's 1,100, these 600, so that's 1,700, and then they sold 400 of these. So what are they left with at the end of the year? They've got 100 of these that they paid $10.30 for, and they've got 700 of these that they paid $10 for, and that's what you see down here. And so their total ending inventory under LIFO is $8,030. And I'll do a slide at the end that compares all three of these. Finally, we've got the average cost method. So we know that they purchased a total of 2,900 basketballs and they paid $30,210. They've got 800 of them left. What is the value of those 800? Well, they paid $30,210 for 2,900 basketballs. So their average cost per unit was $10.42. Multiply that by the 800 units that they have in inventory, and the value of their ending inventory is $8,334. So this now compares those three methods, and you can see under FIFO it was $8,640, LIFO $8,030, average cost was $8,334. Now you might look at this and say, well, it's not a huge difference. It's $600 between FIFO and LIFO, but remember, this is one product. If you start multiplying hundreds of products or thousands of products and thousands of units of products, these numbers can become very large. And so this is why businesses can have a significantly lower tax bill if they use LIFO than if they use FIFO or even average cost. And that's why the IRS is going to scrutinize it more carefully. But this just gives you an idea of how this works, especially in times of inflation. If there were no inflation and they paid the exact same amount every time they bought basketballs, then there would be no difference here. They would all be exactly the same. It's because they're paying different amounts at different times that you are going to have these different results. There are other methods. So the method we were just talking about was the cost method, and then we had those different ways of determining the cost. But you could also use something called the lower of cost or market method or the retail method. You might get a question about each of these. You don't have to know them in depth, but let's just understand what they are. The lower of cost or market method, it compares the cost of the items to their market value. So this would be used for items that tend to lose their value quickly, such as products that are fads or where consumer tastes change quickly, such as fashion. So maybe you've got a bunch of last year's dresses that didn't sell, and now this year's dresses are out, and so last year's dresses are kind of blasé. Nobody wants to purchase them anymore. So those dresses may not be worth even what you paid for them. So what this is saying is that you look at how much did we pay for those dresses versus how much are they actually worth now, and you can use the lower of those two numbers in order to determine your inventory value. And the market value, to determine that, it's based on the normal selling price of the items as of the inventory date. And our last method is the retail method. Here, the total retail selling price of goods on hand at the end of the year in each class of goods, so you go class by class, is reduced to approximate the cost by using an average markup expressed as a percentage of the total selling price. So if your markup is 40%, you would use that as the basis for valuing your ending inventory. So if you know, okay, we've got this much at this retail price, we know our average markup is 40%, therefore we can compute what our approximate cost is of these products. That is the retail method. You do not need to know how to compute that, but if you want more examples or to understand it better, you can check out publication 538 and it will walk you through that calculation. And that is the end of video 2. In our next video, we will discuss assets and depreciation. So I will see you in video 3.